Costco sold almost $270 billion of merchandise in one year, but after paying for those products, only around 11 cents from every sales dollar remained. That sounds like a terrible business. And yet Costco generated more than $6 billion in annual net income. So how does a retailer make more money by refusing to make too much money on the things it sells? The answer is not the giant warehouse. It is not the hot dog. It is a decision system that turns low prices into something far more valuable. Trust. Every retailer faces the same question. You buy a product for one price. What price do you sell it for? Raise the price and each sale becomes more profitable. But raise it too far and customers buy less. Or worse, they stop trusting the store. Most retailers try to win that trade-off product by product. A little more margin here. A premium brand there. A discount that looks good but only after the original price was quietly inflated. You have seen that game before. You have felt it. That moment when a sale price feels suspiciously convenient. When the markdown is bigger than the product ever deserved. When you leave the store not quite sure whether you got a good deal or just a good feeling. Costco made a different bet. It decided that the long-term value of your trust was worth more than the short-term profit on any single item. That sounds simple, but it changes almost every decision inside the company. What products it sells, how many options it gives you, how it negotiates with suppliers, and why it still sells a hot dog and a drink for $1.50. I have spent more than a decade inside planning and finance teams, building the models that show where a business actually makes its money, not where it says it does. So let's step inside the boardroom. Here is the decision Costco made, and almost no competitor has ever been willing to copy. The first thing to understand is this. Costco is not just a retailer. It is a membership business disguised as a retailer. In the United States, a basic membership costs $65 a year. An executive membership costs $130. You pay before you buy a single television, before you pick up a tray of salmon, before you grab that oversized box of snacks you did not plan to buy. That changes everything about the relationship. At a normal store, you can leave and shop somewhere else tomorrow. At Costco, you have already paid to be in the system. So the company has one job: make you feel that membership was worth it. Every single time. The cheap gasoline helps. The discounted electronics help. The rotisserie chicken helps. And yes, the $1.50 hot dog helps. They are not just products. They are evidence. Evidence that Costco is keeping its promise. According to Costco's public filings in fiscal year 2024, the company collected more than $4.5 billion in membership fees. Its renewal rate in the United States and Canada was above 92%. That is not just loyalty. That is recurring revenue, collected before the company sells a single item. And recurring revenue gives Costco something every executive in every boardroom wants: predictability. Costco can plan better, buy better, staff better, and invest with more confidence than any competitor running on transaction margin alone. The real lesson: the membership is not a side business. It is the economic engine that gives Costco permission to keep prices low. Here's the uncomfortable version of that. Costco does not actually need you to buy anything. It just needs you to believe you will. Low margins are not weakness. They are a weapon. Most retailers treat margin as a scoreboard. Higher is better. Costco treats margin as a strategic choice. In recent fiscal years, Costco's gross margin on merchandise has sat at around 11 to 13%. That means after paying suppliers, roughly 11 to 13 cents from every sales dollar remained, before wages, rent, logistics, and everything else. Costco could raise that number. It could add more margin to branded products. It could inflate starting prices to make discounts look bigger. It could quietly introduce higher margin product lines. But that would damage the relationship. Costco wants you to believe one specific thing. When you see a deal inside the warehouse, it is a real deal. Not always the lowest price anywhere on earth, but real enough that you do not need to spend an hour comparing alternatives. That saves you time, and it makes you more likely to spend. This is where the model becomes a flywheel. Low margins create trust. Trust creates repeat visits. Repeat visits create volume. Volume gives Costco more leverage with suppliers. Better supplier terms protect low prices, and low prices create trust again. A normal retailer asks, "How much can we make on this item?" Costco asks, "Will this item make the membership feel more valuable?" That is a completely different decision, and it produces a completely different business. So if the flywheel works, why hasn't every competitor simply copied it? The answer is sitting in the food court. The $1.50 hot dog is not about the hot dog. The Costco hot dog combo has stayed at $1.50 for decades. Inflation went up. Labor costs went up. Ingredient costs went up. The price did not move. Why? Because the hot dog is not lunch. It is a message. It tells you Costco is still on your side. And that feeling travels with you into the warehouse. You walk in planning to buy paper towels. You see the hot dog. You see the rotisserie chicken. You see a television at a price that is difficult to ignore. And somewhere in your mind, a calculation runs automatically. If they are willing to hold the line here, the rest of the store is probably worth trusting too. That feeling has direct economic value. It increases basket size, visit frequency, and renewal probability. Costco reportedly restructured its supply chain and brought hot dog production in-house rather than simply raise the price. That decision tells you everything about the company's priorities. The question was never, how do we protect the food court margin? It was, how do we protect the promise? The real lesson, the most valuable product in a business is not always the most profitable one. Sometimes it is the one that makes customers trust everything else. Quick note, specific figures referenced here are based on Costco's publicly available financial filings and widely reported industry data. They are used to illustrate the financial logic, not as confirmed internal forecasts. But here's what most people miss entirely. The hot dog protects trust today. Kirkland protects it forever. Kirkland is not a brand. It is a retention system. Kirkland Signature, that Costco's private label, now accounts for roughly a third of all Costco revenue. That number grows every year. Here's why that matters from a financial perspective. When you buy a Kirkland product, there is no price comparison. There is no Amazon listing. There is no Target equivalent. Kirkland olive oil, Kirkland batteries, Kirkland cashmere, Kirkland vodka, widely reported to be produced by the same distillery behind Grey Goose. You cannot buy these things anywhere except Costco, which means to keep accessing them, you have to keep your membership active. Kirkland products are almost always priced below the branded equivalent, but Costco imposes strict quality specifications on its suppliers. The product must match or exceed the branded alternative. The result, a product that wins on price, wins on quality, and exists exclusively inside the membership. That is not a coincidence. That is a retention mechanism built directly into the product line. And it is the reason copying Costco is almost impossible. You cannot replicate Kirkland overnight. The supplier relationships, the quality standards, the customer trust in the label, those took decades to build. Any competitor can build a warehouse. Any competitor can lower prices for a quarter. Nobody can manufacture 40 years of earned trust on a shelf. Takeaway: the most effective loyalty program is not points or discounts. It is creating something your customer genuinely cannot get anywhere else. So the model is durable. The flywheel spins. The trust compounds. But there is one thing this entire system requires that most companies are unwilling to give: the discipline. Most businesses cannot maintain Costco's model works because it inverted standard business logic, and most companies will never copy it. Not because they do not understand it, but because it requires genuine short-term sacrifice. The standard logic: maximize margin on every transaction. Costco's logic: minimize margin on every transaction and maximize the probability that the customer renews, returns, and trusts the system again. That inversion is intellectually simple and operationally brutal. It means watching your merchandise margin stay flat while a competitor reports stronger quarterly numbers. It means keeping the hot dog at $1.50 when every cost line around it has moved. It means building Kirkland to give the margin to the customer instead of keeping it. Every quarter, someone inside that organization could make a rational argument for raising a price, adding a margin, extracting a little more from the transaction in front of them. The discipline to say no, consistently for decades, is the moat, and it applies far beyond retail. Every business and every career eventually faces the same version of this question. Are you optimizing for the transaction in front of you or for the relationship that makes the next transaction inevitable? So why does Costco make more money by charging you less? Because lower prices are not the end of the strategy. They are the beginning. Low margins create trust. Trust creates membership value. Membership value creates renewal. Renewal creates predictable revenue. And predictable revenue gives Costco the power to keep making long-term decisions while competitors chase the next transaction. That is the hidden logic behind Costco. Not a cheap hot dog, not a giant warehouse. A system built around one idea: make customers feel smarter for coming back. Here is your one question to take away. Next time you see a company selling something suspiciously cheap, do not only ask how they are making money. Ask the better question: what is this price making me believe? Because the most sophisticated business models are not built around transactions. They are built around trust. Every billion-dollar company has decisions most people never notice. Every week on Logic Atlas, we reverse engineer one of them. Not from the outside, from inside the boardroom.